Folks, given the morning that's in it, we might just take it out and proceed, and we'll keep an eye out for Betty if that's okay, and I'll keep a weather eye out for an admitter when and if she togs out. So good morning, everybody, and thank you for taking the time to join us here this morning. We have a little bit of work to get through, and the purpose of the exercise this morning is to take a good walk through the essential board member in terms of corporate governance responsibilities, in terms of being a director of a state board. And we're going to do a belt and braces exercise on this. So I apologize in advance. It's quite detailed, it's very wordy, and there's quite a few slides to go through, but there's no shortcut through it. And we want to give you a comprehensive briefing. So I would ask you if there's any questions at the back end, maybe just keep them to the back end and I'll deal with them. Or indeed, if you just want to tabulate your thoughts, and if you want to put in or email in any questions, happy to do so. I think just from the process this morning, if we're stopping and starting through it, it probably wouldn't be as fluid. So from that purpose, if it's okay with you all, any questions, I'll take them at the end, or if you want to email them in, happy to follow up on that as well. So without any further ado, and I think we've got Catherine, Ellen, Owen, Michael, Nuala, Philip, and Rachel with us here this morning. So I'm going to go over now to a slide deck, and if you can just confirm you can see that when I bring her over, that'd be super. Thank you. Now, can everyone see that slide deck? Okay. Can people see that slide deck?
Yep.
Okay, super.
Yes, that's great.
Okay, super. So the purpose this morning is to go through Governance Ireland course in terms of the essential board member for state bodies. And we're going to go through, I guess, 14 different sections, give you an overview of corporate governance frameworks, go through the board structures, what they're for, what they do, how they work, look at the purpose and duties and responsibilities of the directors, look at your legal and regulatory compliance issues, examine the criteria for appointing directors, look at the key components of an effective board and board members, the principles for effective board meetings and how they work and how you operate best practice in that space. Take a look at strategic leadership, which is one of the prime missions of boards. Look at risk oversight, the understanding of risk management and practice, and sustainability, board development, succession planning. Clearly, on state boards, it's a little bit different given the composition, how the nomination process works through the pass or through the electoral college element. Some common mistakes we'll deal with in terms of boards and what happens and how to avoid some of the pitfalls. And internal pressures involving directors, managers, and just in the broader community, owners and founders, for example, just in a broader context of governance. And we'll conclude with the essential board member, just tips and tricks and some takeaways. So I'm Pat Downs from Governance Ireland. My background is in the space of corporate governance, and also have had a career in the corporate space and the commercial corporate space, and have served on state boards as both an executive and a non-executive. And equally, I would have had a broad kind of history in terms of the commercial space. So I have a good knowledge of both the state sector, but also the commercial sector as well. Previously, I would have been chair of the Corporate Governance Association of Ireland, and have undergone various academic bits and bobs over the years, which I won't bore you with. And that's my background in a nutshell. LinkedIn, you can check it out as you wish. Governance Ireland is a bespoke consultancy. All we do is board effectiveness and evaluations processes, and equally we do training in this space as well. So we have a number of partners, and they come from, I suppose, both the state sector and the commercial sector and the financial sector and the charity sector. So we have a good cross-purpose and a good cross-reference of skill sets that we deploy, but we specifically deal in corporate governance. That's our meat and veg. This morning we have obviously yourselves. I'm not going to go through an introductory process. You all know each other, so there's no need to do that. But we have yourselves with us. I think we're still waiting on Betty. I'm just going to check. She's not with us at the moment, but we'll just keep a weather eye out for her. And again, I'm delighted to have the opportunity to talk to you. It's a strange time, as we said earlier. The virtual learning is quite good from reducing our carbon footprint and the use of energy in terms of less traveling and so on, but you can suffer from Zoom fatigue. So I'm conscious of your time this morning, and we have quite a lot to get through, so I will try and do it at pace, and I hope we'll keep it interesting for you. So the course content, I would use the term board throughout in reference to the oversight authority, yourselves, and the entity of an organization generally. You could have, for example, in universities, you have a different lexicon in place, and different organizations, charities often have different terms for their boards as well. But just for the purpose of the exercise, we're going to use the term that you use, which is board in this instance. Clearly, not all boards have the same size, their structures, needs and resources. And I just note to you that you need to think proportionately and relevant to the size and scale of your boards. Try to benchmark your thoughts as I present this best practice governance material in that sort of context. Obviously, the HSE is a huge organization in terms of scale and scope and size and headcount relative to the Legal Aid Board, which is still not in considerable size. So the underlying principles certainly cascade right through all the organizations, but there is an element of proportionality that you need to bring to bear as well. And good governance standards are common to and necessary for all organizations, regardless of size. As I said earlier, sorry, but by necessity, the presentation is going to be wordy, so please bear with us, and we will circulate this afterwards. So some essential questions prospective directors should ask before you join up. And I would make the comment, obviously, with boards that are state appointed, this is a voluntary exercise. People put their hand up generally and volunteer to go forward. So you are putting yourself forward for this. And that's public service at its best. But notwithstanding that, before you do that, you should probably consider, why am I being asked to serve on this board? Why would I want to serve on this board? What does this board expect of me? And is it meeting my expectations down the line in terms of the experience that I've seen to date? What skills and experience am I expected to bring to the board? And you will see this in terms of the past process, because normally in the last 24 months, they have evolved to show a little bit more granular detail in terms of what the ideal candidates might look like. And what tenure and time commitment has been asked of me. Time is a huge issue. And people need to be very mindful of this, particularly when you're on boards where you're doing it, out of a public good and a sense of commitment to the profession, perhaps, and the greater good. But the time element should not be discounted. And will I be able to make a positive contribution to the board? Whose interests am I representing? How are the board members, engaging? How long have they been involved? How long will I be serving on the board? Is there an evaluation process in place for board members? Is there a comprehensive induction process? The induction process is very important, and again, we'll touch on that later. So these are some of the questions that you need to ask yourself before you come on board. And once you do get on board, there are 6 questions that I think that you should probably keep asking yourself repetitively. They're good touchstones just to kind of come back on. And for example, they would be, do I believe I have all the information? This is one that is cascaded right down through all the corporate governance disasters where transparency wasn't the order of the day and people weren't getting full information. You need to be happy in your skin that you're getting the right information. Do I have the necessary skills to make this decision? And if you feel uncomfortable that you don't, perhaps you need upskilling and you need to make, I suppose, a case to the board that ongoing training in particular areas may be relevant and may be pertinent and may be beneficial to the board. One of the big areas that we see on an ongoing recurring basis is, do I have any conflict in this matter, and dealing with conflict? Now, we'll come on to that in a little bit more detail later on, but conflict is certainly an issue that has arisen over the last couple of years and is right at the top of the agenda. And I would expect, if I was to look at your own agenda, board agenda, conflicts would be either number 1 or 2 in and around the space of the minutes from the last board meeting. You will be asked, are there any conflicts to be declared? And there's a reason for that over the last period of time. You need to remain objective. Is this a rational business decision? You are being brought to bear, your skills are being brought to bear as independent people. So even though you may come from different constituencies, if we will, once you go through the door and you're sitting at the board, you have to bring your independent frame of mind in terms of how you go out making your decisions. And therefore, you need to look at it cleanly, clearly, coldly in terms of the decisions that you're asked to make in terms of the business cases that are brought to you by the executive. Independence is key, independence of thought, and that's actually the core value that you bring outside of your parochial skill sets. It's your objectivity, it's the independence of your mind in terms of teasing out the questions that you're being asked to deliberate on. The Joe Duffy question, as we call it at the moment, can I explain this in a transparent manner? The landscape of corporate governance is littered with material cases of where transparency didn't apply. So, you need to be comfortable that the decisions that have been made, that you can explain them in a transparent manner, that there's nothing obfuscated, that they are very self-evident in the reasons why you arose in terms of arriving rather at this decision. And is it a responsible discharge of my duties? Are you doing the right thing for the right reasons? And is it within the context of the rules of engagement in terms of what your board is missioned to do? And when you've joined, again, do I believe I have all the information? Sorry, forgive me, that's a jumper. So what is corporate governance? It's defined as the system of principles and processes by which organizations are directed and controlled. And that's a reference from the OECD. The core principles underlying corporate governance are based on conducting the business with integrity and fairness, being transparent with regard to all transactions, making all the necessary disclosures and decisions, and complying with all the laws of the land. It is broadly concerned with the relationships between the board and board's stakeholders and the accountability and responsibility towards these stakeholders. Agency theory, but it's important to know in terms of the state code who your stakeholders are and to evaluate if you're correctly engaging with them. And it's a question that's come up in recent times in terms of stakeholder engagement, and it's part of your duties to have I suppose, and satisfy yourselves that you're engaging with the stakeholders and that you're not getting your primary feed through the executive. So it's something we will touch on later as well. Good governance should facilitate effective and strong management that underpins and delivers the mission, the vision, and value over the longer term. Always bear in mind that conundrum that you are there from a strategic point of view, not a tactical point of view. So it's your role to provide strategic leadership. It's the executive's role to deploy tactical leadership. So why does good governance matter? It's all about transparency. If there's no trust, no credit, no investment, no growth. If an organization does not have a reputation for strong corporate governance and practices, capital will flow elsewhere. If investors are not confident with the level of disclosure, capital will flow elsewhere. If a body opts for lax accounting and reporting standards, capital will flow elsewhere. Again, it's all about transparency. It's all about giving assurance to people where the investor money is safe and secure. A little bit different in terms of I suppose, state bodies, but the same principle still applies. The taxpayer ultimately is who is funding this. So they need to be assured that they're getting value for money in terms of the euros that are being deployed and spent. So in terms of the financial oversight, in terms of the recent, I suppose, debacle of the financial crisis. And again, we're heading into another crisis and we're right in the middle of it, but there will be fallout from it in due course. So the lessons that we learned from the last time can also be applied as we move forward and should be. So there was insufficient safeguards against excessive risk taking, clearly in the banking sector that was self-evident. There was widespread existence of boards which were ill-equipped in terms of competence and skills to understand their business responsibilities. There was a lot of the old boy network, if we call it that. NEDs were often known as the nodding donkeys, where they would nod things through. And the landscape, again, was littered with disasters where people just took it on faith that they were being told the right thing. So the attendant risks insufficient to enable them to challenge executive management. Financial institutions and indeed regulatory regimes tended to mimic their counterparts in other jurisdictions. We ourselves regularly do that with the UK, or would have done in the past. And now we take it from the European context. We still need to stress test all of the stuff that goes through. And the results from that was that we saw a similar mirror across all jurisdictions in terms of the financial crisis, that they tended to be quite similar, with consequential disastrous results. But values and behaviors is very important, and that's very important in terms of the code of governance for state bodies as well. Is it box ticking, or is it real life? I hate the term box ticking, to be honest with you. I think corporate governance is a way of doing business. It's an ethos. It should kind of be prevalent right across the organization in terms of how you go about your business, that you're right and proper, and you're doing things in an appropriate fashion in the best interest of the stakeholder. And it's about your attitudes and behaviors and ethics. Bear in mind that you are the figureheads of the organization, and how you behave and how you respond very much is reflected right across the organization, because they take their ethical and moral leadership from the board. So it's important that you are, as I suppose, the head figures, that you send out those kind of behavioral norms as being the expectation of excellence that you come to expect as the board. And it's called tone at the top, and the code of conduct that you operate to. So board behaviors are important, and they do matter, because they send out the signal. People, you know, we're all the same. We do as we see, not as we're told. So people will respond to you know, leadership in terms of what they see, not what's been imposed on them. And the quality of the key relationships is very important to keep those healthy, and that there's a healthy tension between the executive and equally between the board. Your job, and I'll come on to it in a little bit more, is to maintain that healthy tension in a positive and proactive fashion. But that in the end, that you have a shared ethos, that you have a collective responsibility to deliver on the greater good. So the main impacts of good governance are obvious when, for example, we would look at when they're missing. So if you think about, you know, the different stakeholders that you may have, you could have your customers, your clients, the members of the board of itself, you have your employees, you have your regulators. So you have those group of stakeholders in the first flush, and you probably have many more as well. But if you think about it then in terms of all the examples where there was a disconnect from that, and you know, I threw up a few here yesterday when I was looking at this. You have FOSS, TUSLA, Anglo-Irish Bank, and all the banks indeed were none without blemish. The whistleblowing and Garda Síochána and the reputational risk that followed, and you know, the charities is littered with that. And I'll touch a little bit later in terms of charities, because that's very much in the zeitgeist at the moment. And there's a ticking kind of clock there where people have to comply and explain by the end of the year. And there's a huge amount of movement in that space. So, you know, you have Consol, CRC, Rehab, St. John of God's, Oxfam, there's any amount of them, where transparency probably was lacking. I don't think a lot of people would be guilty of going into charities with any malcontent or malfeasance, but through various kind of different issues, being on boards and the reputational risk that flowed from that, they took it on faith that the information that they were getting was right and proper, which wasn't necessarily the case in all organizations. And as a consequence, they suffered reputational damage. Credit unions, you'd be familiar with, there's any amount of issues over the last couple of years. The FAI, I'm guessing that recent book will be on the Christmas best list, you know, and that was a difficult challenge where the executive in the body of a particular individual probably got way too much power and way too little transparency. In the Olympic Council of Ireland similarly. So there's a huge amount of examples that in the Irish context you would be familiar with, and that's not to mention on the European context and a global context. And that's why corporate governance matters and transparency matters. And if you take anything away from this, transparency is probably the order of the day. One sees, you all see, so that there's a consistency of information right across the organization, that you're getting the same information, that you're making ultimately your decisions on. So The converse of that in terms of poor corporate governance examples would be the actions that derive the disasters that occur. So taking uncalculated risks which have serious consequences, dishonesty, withholding information, distortion of facts. I'm not going to go through all this, but if I look at a few, the big boys on the block to me would be conflicts of interest, endangerment of people. Health and safety is particularly at the moment, a huge issue, and people need to be mindful of their duty of care on that to staff and to the population in general. Reputational damage is an ongoing challenge in terms of board participation, as I call it, the Joe Duffy factor. It was in the old days, it was the Charlie Bird factor. So you get that knock on the door and a microphone is stuck in your face on a Saturday morning, and you know that issue arises. Unnecessary waste is another point to be mindful of in terms of sustainability and so on, and good use of I suppose the resources that are being made available to you to use that money as if it was your own. And be mindful that there is a requirement to account for all that, and you are to a large degree responsible ultimately for that. So whatever the business, public, not-for-profit, there are all some common features. So the owners, the funders, the shareholder, the government, the taxpayer, they all have a shared objective or purpose. So they have invested a resource in you and the funds to achieve it in terms of the board. They need to place their trust in the management and the team. They want to ensure the right results are achieved, that the greater good is delivered. They want to have an ongoing involvement or contact, so they need a regular reporting cycle that KPIs and strategy and vision has been met, hence the annual reporting cycle and AGMs. They don't need to have an ongoing access to detailed information. People don't need granular detail on a day-to-day basis. They vest that trust in the executive. However, they assume that the board will have oversight of that, which they will report back to them. So therefore, they appoint you the board. And that's the expectation in terms of the all common to all boards, that they have that expectation. So what gives them assurance? Stakeholders, funders, you know, what makes them worry less? What allows them to sleep at night? If the board sets and oversees strategy, approves business plans and budgets, this is the expectation, that the basic expectations that they have in terms of what you're doing, why you're there, what boards are commissioned to do. To oversee the performance, to ensure that you tease out with executive management that the KPIs that you set in terms of strategy KPIs are being delivered on, and if not, why not? And that there's a clear, transparent logic behind, I suppose, the strategies that are put in place, the business plan underpinning the budgets, for example, and that you appoint competent management, that you oversee risk management. And clearly that's a huge one for all boards in terms of risk management, and making sure that there's an appropriate risk framework in place. I'll touch on that later for you. So we'll do that in a little bit more detail. Ensure sustainability into the future. You need to kind of be mindful of your own life cycle in terms of the board, and keep a weather eye in terms of the replenishment and refreshment of the board. Now, again, in terms of state boards, it's a little bit different insofar as generally the minister appoints, often from nominations, self-nominations that come in through the pass system, and then through the electoral college if there's employee or worker directors on the board. So, but again, you know, it's no harm to do a skill set audit of the board every now and then, just to do a snapshot that you're not top heavy in certain skills, that you have a broad diversity mix on the board. And diversity is not so much about gender, even though that's mandatory. It's also about, I suppose, frame of mind and cultural diversity, that you reflect the landscape within which you operate. So again, no harm every now and then to do within the life of a board, in often case 3 to 5 years, that you do a snapshot skill set audit, so that you can inform yourselves moving forward any softness on the board that you may like to augment. And even in terms of state boards, the chairman can advise the minister and the department in an ideal scenario that the candidates that they would be looking to refresh with would have these complementary skills over and above the mandatory requirements that will be laid out. And that can be helpful to the minister as well. So, and I see that a lot more going through, where chairs after skill set audit are advising the department of ideal candidates may look like having these additional skills over and above the basic requirements, and that can be helpful. And you'll see that in the past system now, the public appointment system, where the call for applications to become members of state boards is becoming a little bit more detailed. So you have the basic requirements, and then you have the parochial requirements that are applicable to a particular board. So for instance, in terms of the Legal Aid Board, you will have a broad range of skills on your board. However, there may be self-evidently some skills that you wish to augment, and that can be something that you can advise to the minister as part of your process. And equally, in the electoral college element of the worker directors, you can also, they can take it on board that these would be complementary skill sets such as they wish to consider. Mandatory insurance of legal and regulatory compliance. Ultimately, you are responsible and accountable for that. So that's an element of the equation you need to be mindful of, and that there's an expectation there that you're delivering on it. And on an annual basis, you provide a true and fair account of the results. And again, all state boards are required to deliver that. And you will also have a letter of engagement from the department laying out some KPIs that you will operate to, and they will be reported on. So a typical board framework, if you will, I just put this together just to give you, I guess, a look at what it might look like. So overarching, you got the shareholders, the minister, the public, the owners, the employees, and so on in terms of their representation. You've got the appointment of the board of directors, you've got the chairperson, board meetings, corporate secretary, reporting and disclosure requirements, board operations, and cascading from that, you've got all the bits that the board needs to do in terms of strategy, policies, laying in government's instruments and reporting, monitoring and evaluation, and key areas of responsibility in terms of, I suppose, the actual particular focus of the board in terms of what you're about and what your vision and mission is. Governance systems and controls. Down from that, you've got the CEO and management, board subcommittees, which we'll touch on, and they're often parochial, but you have some standard ones, risk and audit, for example, that you have, remuneration committee, the executive committee, internal controls, and audit, and so forth. So that's kind of a general one that a lot of state boards would have in some form or fashion, and that would be the robust framework that gives you assurance in terms of, I suppose, laying in a metric that you can kind of pull the apple tart together in terms of baking the pie. So, and we'll send this out to you afterwards as well, folks, in terms of the presentation, just to give you some assurance on that. So the governance codes are in place. There are many, many of them. And if you look at, we discussed earlier in terms of the UK, where we take a lot of our guidance from in terms of best practice in a lot of cases. So they're split between rules and principles. We touch on some history in terms of the Cadbury report, the types of codes, and the relevance for you in terms of the state code. So codes of governance and ethics can be described as either principles-based or high-level or rules-based and detailed. Proponents of the principle-based one argue that this approach is robust and flexible. It provides guidance that can be applied to the infinite variations in circumstances that arise in practice. It can cope with rapid changes of the modern business environment, prevents the development of a mechanistic box-ticking approach to decision-making, and the use of legalistic loopholes to avoid compliance with guidance, and focuses on the spirit of the guidance and encourages responsibility and the exercise of professional judgment, which are key elements of professions. Supporters of the rules-based one approach argues that compliance with specific guidance is easier, since the requirements are prescriptive and they leave little room for misunderstanding. Rules-based approaches are certainly more easier to enforce, and as the time we live in terms of level 5, that argument can be applied in terms of both as well, in terms of principles and rules-based, although you know, the jury's out on that as we speak. So in practice, codes of governance and ethics are a mixture of principles and rules. So both elements of the equation are brought to bear. And you know, there is an overarching thing, I would say. Sorry, I'm just letting Betty in. There is an overarching thing, which is a rare commodity that all board members should bring to bear as well, and that's common sense. And I say that advisedly. Common sense is something to be considered. And sometimes if information that you're getting just doesn't stack up, even though all, the professional kind of guidance and stuff that you're getting tells you that it is as it is, your common sense still should be deployed in the board, and you should ask the questions. There are no stupid questions. Okay, so always, if you're uncomfortable or something is just niggling at you, ask the question, clarify your query, and bring it up. Don't be regretting afterwards that you should have asked something. You were there to ask questions. That is ultimately the expression of your duty as a board director. Ask those questions and assure yourself and give yourself comfort that you did ask the questions. Again, that's a big takeaway. There are no stupid questions. Ask the questions. If you have a gut feeling, get it out there and ask the question. So which code applies? So this is a very busy slide. I'm not going to go through any of it, but that's just an example of the UK. There are 34 codes that we would touch on when we were doing Northern Irish based companies that we would take a look at. So I mean, that's quite a heavy amount of codes, and there's more coming through all the time. A lot of it would come from the Higgs report, where that would have been the genesis of a lot of the current codes. But when you think about it, codes of practice and codes of good behavior have been with us from the very beginning. And you can throw your mind back to one of the first codes would have been the 10 Commandments. They've been with us since the very essence. People forget about this. We talk about codes of governance as if it's a new thing or if it's something that's arisen in recent years. We've had codes of behavior and codes of practice from the very outset, going back to the ancient times. I won't challenge myself to give you the 10 Commandments, but certainly thou shalt not steal is one, and thou shalt not covet thy neighbor's goods, which are the very essence of corporate governance in terms of being mindful about good behaviors corporately. In terms of tandem reflections in terms of our requirements and their requirements, if we look at the UK code, which very much mirrors the Irish code in terms of the Companies Act, the board of directors should meet regularly, retain full and effective control over the company, and monitor the executive management. There should be a clearly accepted division of responsibilities at the head of the company, so that there's a very much a clear breach between the executive and CEO and the chair and the board. And again, take away from that, every now and then it's good practice at a board meeting to have an element of the board at the end that you sit within your own body, external to the executive management, so that you sit alone and outside that, and that you have a chat among yourselves without the executive present. That's good practice. And in the past, we've seen a lot of disasters where chairs became executive chairs, or CEOs had too much power, and we've touched on a few of those earlier. So again, there's very important logic that there's a very clear separation of church and state in these affairs, if I can use that analogy. The board should include non-executive directors of sufficient caliber. It should have a formal schedule of matters specifically reserved for decision. And there should be an agreed procedure for directors in the furtherance of their duties to take independent professional advice if necessary. And again, that goes back to that point about questions. If you're uncomfortable or you feel that you don't have sufficient knowledge of a particular area, go get expert advice in the particular area. So as non-exec directors, you should bring your independent judgment to bear on issues, as we've discussed. The majority of a board should be independent of management and free from any business or other relationships that could materially interfere with the exercise of your judgment. You should be appointed for specific terms. Normally on state boards, it's 3 to 5 years. And good practice, and they've been trying to do that over the last period of time, is to actually stagger that so that there isn't a hemorrhage of corporate knowledge at any particular time. We've seen that in the past where a board lost all its directors at a particular point, particularly now that you can only serve really for 2 tours. And there was a danger there. So they're trying to stagger that to avoid that issue. And again, there's a formal process which the public appointments process underpins, and ultimately the minister appoints. Executive directors should have contracts in place. That's not necessarily 3 years. in this instance, but often in state board CEOs will be appointed for 5 years, 5 years with an opportunity to extend it out for an additional 2. But state boards have different processes. So that's commercial and semi-state rules of engagement. I'm not quite sure across the legal aid board that may not apply. There should be clear and clear disclosure of total enrollments in the annual report. And again, the remuneration committee should set in the KPIs in terms of any performance-related pay that comes up and is nominated. And there should be reporting of that, and it should be clear. So again, there's pan-European codes which cascade down through Irish law, and there's any amount of those. These are just a few of the big boys on the block. And there's some reviews going on at the moment in terms of corporate governance in the EU, and arising from Brexit, I've no doubt there'll be a few more as well. In the Irish context, which is more of interest, we have the Corporate Governance Code for Credit Institutions and Insurance Undertakings, the CBC, the Code of Practice for Good Governance of Community, Voluntary and Charitable, again was revised in 2016, and this is an important year in terms of that context. Some of you may be serving on charitable entities, and I'll just touch on that a little bit later just to go through that. And there's the Corporate Code for Irish Domicile Collective Investments in the financial space, and so on and so forth. And even in terms of the HSE, there's service level agreements, including governance frameworks and requirements for Section 38s, 39s. And, you know, you see quite a lot of issues in the past in terms of that space as well. So all for good reason that these codes have been updated. And codes, again, are living documents. They should be refreshed on a regular basis. So, for example, the Code of Governance for State Bodies was refreshed actually earlier this year, and there was an amendment put in to address diversity and diversity reporting. So that's actually only come on in the last couple of months, and that's a mandatory requirement in terms of the annual reporting and the composition of the board in terms of both gender, but the broader diversity as well. So that's a recent evolution in terms of your own particular legal framework and requirements. So again, they're living documents, always worth keeping an eye on. And I would always say to boards that they should, on an annual rotational basis, put an agenda item just to touch on regulatory updates, so that the board is aware and updated on any adjustments, amendments, or new regulations that come on board. Ignorance is not an excuse in terms of the requirements of compliance and the regulatory frameworks. So I would commend you just on an annual basis, just to get an annual refresher in terms of your foundation documents, and also the code, and any updates in terms of a particular legislation that applies to yourself. I'm sure you're doing it anyways, but no harm just to double check. So the charities regulator, that's a big one at the moment. There's a huge amount of charities out there, and they're all struggling at the moment in terms of making ends meet to a large degree. But one of the things that they all are required to do by the end of the year is fulfill their obligations under the Charities Regulator Code. And to that end, there's 5 or 6 principles that they're all kind of operating within. I'm not going to go through it. I'll leave it up there for you. But they're a little bit different insofar as that they have to ensure effective leadership of the organization. Again, the charities area has suffered from areas where founders and CEOs have lost the plot a little bit in terms of the mission, and untoward activities occurred. So there needs to be, the boards need to be very clear in terms of ensuring effective leadership of the organization and control of the organization, and particularly going back to that element of being transparent and accountable to their stakeholders. The reporting cycle has become quite stringent in terms of boards, so that whole element of the equation in terms of doing an annual evaluation is a busy space for charity boards at the moment, because they have to do it on a comply or explain basis. And a lot of them are struggling to, I suppose, catch up. And again, there's a cost associated with this in a time where they are challenged. So we're mindful of that, but nonetheless, there's a clock ticking and they need to deliver on that. And that's something we do separately in terms of Governance Ireland, in terms of charities, and we're quite busy in that space at the moment. So behaving with integrity cascades across all boards, and we'll also assume that That's the order of the day, and any of the boards that you're touching on, please God. So the code of practice for the governance of state bodies, which is, I guess, the overarching code that applies to yourselves. That element that I talked to you about of perspective in terms of scale and size does come to bear in this as well, and it allows for that. So I'll give you an example of, this is the HSE. So you can see that's quite a busy one. You're looking at quite a large geography, skills, different spaces in terms of the provision requirement. And each of those elements of the equation have within them their own corporate governance requirements and other governance requirements as well. So there's a huge amount of moving parts for that board to take on board. It's a very, very, very complex corporate governance structure. And what I didn't actually, I suppose, put in there in terms of, I should have just actually, the HSE sits there as opposed to the minister, or sorry, the Department of Health. But notwithstanding that, it's quite a large space, and I suspect it's going to get busier in the times ahead. So if we look at your own one, it's smaller but not unsimilar in terms of that you have your corporate structure in place, you have your statutory board, you have your chief executive, and you have the different functions arising from that. So again, the purpose of that is to actually show that it's important to have a robust framework and structure in place, and that you can see all the different categories that the governance is overarched across and that people are stress tested against. And each of those elements of the equation will have KPIs that you can stress test and have a look at on an annual basis. And that's what boards are to look at. I mean, from a risk point of view, I often say that the risk register is a living document, but it's no harm at each board meeting just to take one of the risks on the risk register and just do a deep dive over the period of your board meetings. So from that context, you can give yourself assurance that you're just, rather than doing all the risk all the time, at least you're actually getting through it in a more granular detail over the period of a year or whatever it is in terms of your risk register. And the same applies to in terms of your reporting cycle. You need to be making sure that each of the directorates is reporting regularly to you and that you're comfortable that you're getting the information that you require. So the meat and the veg, each state body should be clear about its mandate, and from that identity, the various functions, roles, and responsibilities entailed in the delivery of that mandate. Your board is collectively responsible for leading and directing the state body's activities. While the board may delegate particular functions to management, the exercise of the power of delegation does not absolve the board from the duty to supervise the discharge of the delegated duties. I guess what that means is delegation is not abdication. You may delegate it, but you're still responsible and accountable for it. And that's why you need to give yourself assurance that you're asking the right questions and you're getting the right information. The board should fulfill key functions, including reviewing and guiding strategic direction, which is your principal mission, and major plans of action, the risk management policies and procedures, the annual budgets and business plans, setting performance objectives, KPIs, monitoring implementation and state body performance, overseeing major capital expenditure and investment decisions. You should act on a fully informed and ethical basis in good faith, with due diligence and care, and in the best interests of the state body, having due regard to its legal responsibilities and the objectives set by government and agreed in the letter that you would have with the department. The board should promote the development of the capacity of the state body, including the capability of its leadership and staff. And that's where ongoing training, both of executive, but also the board. I think we should say that it's important that you should refresh your knowledge where possible and regularly. And board training is important, hence what we're doing today. But even on a broader space, we would commend you to keep your gunfighting skills up and refresh and retrain. Every day is a school day and it's lifelong learning in this space. And corporate governance is evolving and changing. So be aware and be mindful and keep fresh and ask questions. And ultimately, the board is responsible for holding the CEO and senior management to account for the performance of the organization. So some common governance framework elements. So it's at the core of the code, if you will. So while the government's, sorry, I'm just having a glitch here on my screen. Yeah. So while the word governance in the context of corporate governance refers to directing an organization, governance also includes and extends to policies and protocols, data, child protection, GDPR, code of conduct, health and safety, whistleblower, which is becoming quite an issue in recent times, management structures and practices, accounting and taxation, org culture and habits, systems and admin, strategies, tactics, marketing, advertising, supply chain, logistics, distribution, all the various things. So it's quite a long list, as you can see. And that's really what the framework elements, when they're come together, those are all the elements that you should just be keeping a weather eye on in terms of all the things that ultimately the organization should have in place and that you're accountable for. Now, each of these factors has the potential to go badly wrong, and organizations and individual reputations suffer in some way. The larger the organization and the greater potential for disastrous impact. I would say to you, one of the things I do a lot of is business continuity management planning, and done a lot of those over the last couple of years in terms of assisting organizations to do their BCPs. And I can put my hand up and say that global pandemics was not on my radar to any large degree. We had certainly cold weather. We had the flu to a certain degree in terms of people and staff being out, and we had put in place, fortunately, in a lot of organizations, the ability and had stress tested the ability to work virtually, and that was being ramped up over the period. But I certainly hadn't looked at global pandemics as being a material threat that could lead us to where we are today. So sometimes it's the unforeseen risks, the unknown unknowns that come out and bite you. So you can make best endeavor, and no one will ever fault you for making best endeavor. That's all you can do. But again, it's that reputational risk thing I often remind people of. Be mindful of your reputation. So ask the good questions right across the space. It's a duty of care that you have to tease and probe in that space. So how are boards structured, and what do they do, and how do you work in an ideal scenario? I'm guessing you're going to be doing a lot of this anyways, but just for the avoidance of doubt. So the board has two key roles: to ensure legal compliance, to add value to the organization in terms of its leadership and its strategy and its values and its mission, and its assistance to complement the executive and deliver on the purpose of the organization. So the board is responsible for creating the future, not minding the shop. And again, that goes back to strategy. You're required by mandate anyways to have a strategy in place, which needs to be refreshed and reviewed every 3 years under the code of governance. But you are strategic, and that's often a challenge, particularly over the last while, where people have been, because of the pandemic, have very much been all hands on deck and had to make a lot of tactical decisions. But ultimately, your role is strategic. And it's that crossover where boards can struggle sometimes, in terms of non-executives can struggle to kind of separate in their minds the desire, which is human nature, to get down into the nitty-gritty of the tactical stuff, which is really that for the executive. You can do it post-decision making and pre-decision, but when they're in play and on the field, you have to support them and not get involved too much with them. So you need to step back and look at it from a broader perspective strategically. And the board's job is to govern, and the CEO and the executive team is to manage. And that is the separation, and you just need to keep that in mind and not get bogged down in the separate jurisdictions. So you're there to provide strategic guidance, and that is literally to provide the mission, as I said, the mission and the goals for the company, and to select and compensate senior management. And again, keep an eye on the senior executive positions, that you have a succession plan in place. There is always people movement. People get other jobs, they move for various reasons. And from key purpose and key roles, it's good to just have in mind a fresh set of plans that you can put in place in terms of recruitment of replacement personnel, or indeed just keep an eye of the reservoirs of HR wealth that you have within the organization in terms of succession and progression, and keep an eye in terms of that reservoir there as well, and see that there's good people coming up that you can actually bring up the line as well. You need to monitor and evaluate the performance of the managers. You're not micromanaging them, but you need to just look at the KPIs, and that's why you have at your board reporting certain metrics that you will do. Obviously the financials are there on a regular basis, but you will have also other KPIs which are parochial to your own board, whatever that may be, and you will see them on a regular basis, and that will be reported against last month, this month, last month, last year, this year, and so on, so that you have a metric to look at and a framework to guide yourself against in terms of see
see how it's going, and it gives you a steer in terms of the progression and the appetite for progression that the organization has. And you need to establish organizational policies. You have a duty, firstly and foremostly, to ensure that all regulatory policies are in place. Whistleblowing, for example, is a recent one, and make sure that those policies are all in place, and health and safety, particularly at the moment, that you have robust and up-to-date ones. And that goes back to that element that I mentioned to you earlier about just touching base every now and then to ensure that you're aware that you're up to date on all the regulatory requirements in terms of just an overview of legislation that's come up over the last 6 to 12 months or whatever. And it's a living document, but policies need to be reviewed and refreshed on an ongoing basis. Ignorance is not a defense, unfortunately, so it is a hot seat that you're sitting in. And the best way you can do that is just to check that you're up to date, and also that you have confidence in the people that are giving you the information, which I've no doubt that you have. And again, you're there to monitor and safeguard the financial resources, which is mission critical to any organization, but acutely so in terms of state bodies. You're there to self-regulate. And from that perspective, that's what we're doing there today, to a certain extent, is just having a look at an assessment of your roles and responsibilities. And again, I'm guessing you do a performance evaluation on a regular basis as well. It's required that you do one once a year, but a big one every 3 years. So it gets part of your process, I'm guessing, as well. We do that as well, so I'm happy to provide that service as and when. Risk is a key part of the corporate world. You're expected to set the risk appetite. Ships were not designed to stay in port. You have to go out into the water. There are risks associated with that, but you have to weigh up what's acceptable risk and what is unacceptable risk in terms of what you're about. That's the purpose of the exercise. That's why you're there, to actually stress test the policies and the decisions that you're being asked to make. But you have to have a risk appetite. You cannot, I suppose, sit there idly and have no risk appetite. One of the issues always has been with state entities is that they are risk adverse, and to a degree, maybe so in the past, but I think that's evolving and changing through the robustness of the boards that they're appointing now. The political patronage isn't what it used to be in terms of state board composition, and that you have a much high caliber of people coming on state boards, which is wonderful. And they are asking more questions, and the risk appetite is broadening out, and that's giving a healthier service in terms of what we're getting from state boards, and that's to be admired, and that's actually the purpose of the exercise. And we're getting, as a people, a better return on our investment. And ultimately, you have fiduciary duties, and they're very important as well, and we'll touch on those a little bit more. Again, from a conflicts of interest point of view, that's a challenge. I'll touch on it a little bit later as well, but from a conflicts of interest point of view, Ireland is a small place. That's self-evident. Everyone knows someone. I mean, I'm guessing if I asked anyone on the board, within 1 or 2 questions, we could probably know someone we knew from a communal point of view. And that's the nature of the beast. Everyone knows someone or is related to someone. We're a small island nation. We're the size of Greater Manchester in terms of our population. So really the way of conflicts of interest is vested in yourself. And I'll touch on it in a bit more detail later, but transparency is the way to unlock your concerns in terms of conflicts of interest. If you have one, flag it. The fact that you know someone doesn't necessarily mean that you have a conflict of interest. However, it is a challenge if you know someone and you don't flag it, if there's a decision being made that's material to that person's interest and that you have a conflict. So again, it's just something to be mindful of, and I'll touch on it a little bit later. So the board is always searching for the point of perfect constructive tension, and I've put up a pyramid slide here, if you will, and you've got at the top yourselves, and underneath that you've got the executive directors, and then you've got the chair at the pinch point, and at the other end you've got the CEO, you've got the management team, and you've got operations. So that is underpinned and assisted by the company secretary. And they're meant to kind of come together and work in harmony. And again, you're kind of assisting the management team and operations and CEO. And there's meant to be a healthy tension. Okay, so your job is strategy and oversight, and their job is the management and the performance and the delivery of that strategy and that vision and day-to-day management. And that really, in essence, if you look at it as an inverted pyramid model, that's where it's at, and that's what it's about, and that's what you're there to do. And the chair and the CEO is a very important relationship, and that's why, again, there is a separation there and a healthy tension between the two, but they have to work very well together, and it's very much based on trust and on interpersonal relationship skills. And they're vital that they work in harmony in order for the organization to be healthy and to deliver in terms of its KPIs. So I've just put this slide in just as a general one in terms of the evolution stages of boards. I'm not going to go through it in any great detail, but if you look at the number of stages, you've got about 4 stages: early stage, developing, established enterprise, mature organizations. And then, you know, you've got the different evolutions that board directors find during that period, from founders over to staff, where you have few or none, moving over to more specialized. So to a large degree, you're in the mature organization element there, where you're looking at policy and oversight yourselves. Your focus is on governance, and you're looking at strategic planning. And generally speaking, the majority of your board composition is independent, and your staff are very specialized to a large degree in terms of the endeavor that you're about, in terms of the delivery of your mission. However, you know, we see a lot of startups at the moment which are on the other end of the scale. So clearly you'd have, you know, the board's focus will be on structure and organization, day-to-day survival in terms of their planning, primarily a small, tight-knit board in terms of maybe the founders and a couple of investors, and there's very few or no staff. And that's the Pilgrim's progress through the developing entity stage and established enterprise and mature organization. And that's universal across most boards. And we see that as a good operating model. So which board composition characteristics, I suppose that's the question. Which ones are the ones that we look at in terms of the factors? So, you know, you've got different types of organizations. You've got private, public sector, charity, not-for-profit, PLC. You got the different types of ownership and the primary purpose. But whatever the structure, you know, the board should have a couple of characteristics. It should be representative of the organization's functions, including the sales and marketing, the deployment of your services, your professional services, and that these are common purpose. It should be diverse, as we talked about diversity, and indeed that recent kind of evolution within the state boards that came out during the summer, actually, and we can send it on to you if you haven't seen it, in terms of diversity and the code there. It should be knowledgeable. So while there should be a broad context in terms of the reservoir of knowledge, there should also be specific knowledge which is applicable to the core mission of the organization. And clearly, your own organization would reflect that in terms of the core skill sets of a number of members of the organization, or the board rather, who have parochial skill sets that are unique to the board, and that's as it should be. And but equally, there should be complementary, broader skill sets to allow for that diversity of knowledge. Talk about specialist areas, and again, most boards would often have an accountancy skill set on the board reflected via an accountant. Hey John, how are you? You'd also have a lawyer in cases. Yeah, when we do skill set audits, we take it as read, and we often see that the particular endeavor of the organization is reflected very powerfully within the board, but sometimes they may be soft in areas such as legal or accounting, and that's, you know, or it could be, you know, it depends on, you know, digital diversity is a very big one at the moment in terms of someone with digital skill sets is highly prized in terms of board, in terms of that digital transformation piece. We're doing this virtually. If we were doing it a year ago, we probably would be down at your board meeting doing it face to face. And hopefully we'll be back doing that again in the not too distant future. But if you look at diversity, digital skill sets are highly prized at the moment. So that also regretfully, and I put my own hand up on this, the digital skill set is probably more kind of orientated towards people that are a little bit more younger, digital natives that have come up in this strand. But that also can bring you the diversity of youth, and that's another important element to the equation in terms of diversity. Commitment goes without saying. I cannot overemphasize people being aware before they join a state board of the time commitment. The one thing that comes back time over time again is people say that they were unaware of the amount of time that they were going to put into it. And with the best will in the world, it always seems to kind of be more than you had anticipated. So it's to be commended in terms of public service, but please be aware that any board you go on to, particularly state board, will have a significant time element may not have factored in, and you need to be able to give that commitment before you do it, because otherwise you'll end up being doing yourself a disservice and doing the board a disservice because you're unhappy about the amount of time that you're committing to. You need to be connected, so you need to have relevant constituencies. You need to know your industry and have good contacts, and that's what you bring to the board as well. Is your, I suppose, your stakeholder knowledge, and that's very important. And that's, I suppose, potency that you bring as well. And not too many members. Your board is probably very good in terms of that. Some state boards and councils, for example, if you look at universities, they are huge, although they're not quite state bodies, but they're quite big. You can have some state boards go as far as 22, 23 people, which is like herding cats. It's very, very difficult with the best will in the world to actually get collective decision-making and accountability and responsibility being brought to bear, because there's human nature being what it is, there's particular interests and there's particular constituencies, and that's a very difficult one. So there needs to be an appropriate size and scale. Now that is vested in the legislation that boards operate from, so sometimes there's no choice in these matters, but I'd have to say you're lucky insofar as your scale and size is good and it's workable. It can be challenging if you're in a very large board, and if for no other reason that your voice may not be heard, and other voices that perhaps get an unfair crack at the whip. He who shouts loudest kicks in sometimes in those big boards. So challenges there, be mindful of them if you're on other kind of boards of the size and scale. Going back to those questions that you might ask at the outset in terms of why you're joining a board and when you're joining a board, and doing your due diligence. So all boards need good people. That goes without saying. That's self-evident. But you also need engaged people with business acumen, and courage and integrity and diligence and independence of thought and relevant expertise. You need good group dynamics, constructive relationships. And, we often say that it's very important that the board does an away night, be it a strategy day or whatever it is. My own kind of view on that is it's good to break bread with the board every now and then, just to get a sense of who you are and what the team is. And you can only do that kind of really in a social environment. And it's good to break bread and understand, I suppose, where your opposite number on the board is coming from, so you get a better sense. The challenge of Zoom is that the anatomical linguistics of a board are missing, that kind of body language that you get to know from people when you're sitting around a board from them in a while. That
Donald, can I just interrupt you a second there, please?
Is very important.
Sorry, Donald. I gather Mary O'Connor's in the waiting room. She's trying to get back in. If you can admit her, please. Thank you.
Okay. I think she's come back in. Thank you for that. So again, good dynamics, break bread. We won't be doing that again for a while, I'm guessing, folks. But it is important to break bread and do it probably on the back of a strategy day, take an away day once a year. That is important. Again, you need good, valid information, the right amount about the right thing. So the company secretary, in terms of the information and the pack that goes to you, the timing of it, that the board pack is relevant, that there's enough detail in it, but not too much, that you get it, 5 working days beforehand, so that you have time to think about it and consider it and digest it, and that the information is given to you in a correct fashion. So that you have a formal decision process, the agenda setting, that there's problem scoping, that the decision criteria, alternatives and risk analysis that are all in place, and that you're monitoring and overseeing the strategy implementation. That's what the board needs to be doing, looking at the performance, the KPIs, assessment of the board and senior management on an annual basis through the nominations committee, if you have one, or another committee that it might be vested in. So a very simple board structure would look like the board, CEO, senior management, the audit committee, the governance committee and nominations, company specific committees as required, which you will have specific onto your own mission, ad hoc committees that come together for particular period that are addressing whatever that exercise may be and that fall once that particular process has been dealt with. And the risk committee, risk and very much often is the case that you have a risk and audit, but a lot of boards now are moving to a pure risk committee separated from an audit committee because risk is becoming a real big issue and always has been. But just, I guess if you look at the Comptroller and Auditor General, what they look at on an annual basis, and you would, I'm guessing, come in under that kind of watch as well. Over the last while, they've been, the last year, they've been looking at business continuity planning to make sure that those plans were in place. And I guess if ever there was a right call, that was it. And, you know, the lessons that have been learned during this process should be harvested and should actually kind of fall through to your business continuity planning. This hopefully will be the last pandemic we see in our lifetime, but unfortunately, I probably think not. So the lessons that we're learning should not be lost, and it should be harvested for future reference in terms of the information and the best practices that we've learned. So examples of board committees. So standing committees examples. So you'd have the executive, the finance, the risk, the audit, health and safety, marketing perhaps, fundraising, governance. They could all be standing committees. Ad hoc committees might look like public relations, events, campaigns, ethics, nominations, research, board development, evaluation. These come, you know, and that's an open-ended book. You could have a, you know, an ad hoc committee that might be formed because, for example, what we often see an ad hoc committee in recent times would be, for example, if there's a protected disclosure, a whistleblowing episode, the board may form an ad hoc committee to deal with that specific whistleblowing exercise, and it's specifically vested to deal with that particular one. And once that's dealt with, that falls. And you know, that's a good example of an ad hoc committee that we're seeing at the moment. It's ultimately up to yourselves to organise and determine what committees should exist and what they should do. It falls to the board yourselves to understand you know your business best. So they should be fluid, but they should be static and they should be fluid board subcommittees. And again, you need to be mindful of people's time. You can't have too many subcommittees either, because there's only so many people on the board, and you can't, you literally don't have the horsepower to have a dozen or so committees and do them properly. So just be mindful of people's time as well in order to get best from the boards and subcommittees. Whatever you do, it's essential to have clear terms of reference for all subcommittees. They need to be clear and precise, and the purpose of the subcommittee before setting it up should be clearly decided on, and the level of decision-making powers of the subcommittee. Bear in mind, subcommittees should never be given the power to make decisions on behalf of the organisation. Their role is to make recommendations to the board, for you, the board as a whole, to make informed decisions. Okay, so a subcommittee can only recommend, generally speaking. It would be unusual for a subcommittee to make a decision. It goes to the board to ratify a recommendation, but that's just one to be clear about. And ensure that subcommittee meetings are chaired and minuted appropriately, that the quorum is met for subcommittee meetings. That's often a case where there are challenges with quorum on state subcommittees. And again, as I said, don't set up too many subcommittees. There are only so many hours in the day, and there's only so many Zoom meetings that people can do in the current environment. So don't overpopulate the space. So the benefits of effective board committees are they're there to assist the board in its decision making. They bring together non-executives and management in a more detailed reporting structure. And they filter out operational issues that remain with management, and they focus on strategic decisions required by the board and recommend to the board the output of their deliberations in terms of a decision that the board may wish to make in terms of their considerations. So it generally supports the boards in key areas such as audit, internal controls and risk, executive compensation and management appointments. Again, in state bodies, generally executive compensation is pretty much preset within guidelines and bands and so on. So, but appointments certainly in terms of interview panels and so on. Often in state bodies, the direct reports to the CEO, for example, may be ones that a subcommittee member may sit on the interview panel, depending on how it's done. It could go through the PASS system, and if not, it may be something that the board delegates to a HR committee, who may delegate to a recruitment company or whatever. So there's governance issues and corporate policy issues, and And again, the nomination and selection of non-executive directors, I touched on it earlier. You clearly may have skill sets that you wish to augment the board with, and those skill sets may be percolated up to the minister through the chair in terms of a letter of an ideal non-executive director, in terms of new appointments, in terms of the additional requirements that the PAS publish rather, and that's something to consider as well. Health and safety is a big one at the moment. I think all boards at every board meeting are ensuring that the health and safety issue has been touched on, and to ensure that the staff are operating in a safe environment. That's absolutely critical at the moment, and that's been minuted across the board, and that people are operating within the best resources that are available to the board in terms of ensuring that staff are safe and being looked after in an appropriate fashion in order to harvest the best return from the staff. It's a virtual environment in most boards and most operations at the moment where possible, but at the same token, there are issues around that, and you need to be mindful of that. So they have defined terms of reference and limitations, and as I said, generally subcommittees would have no executive powers. So what is a director? So some regulatory and legal definitions. So a company director is a person appointed usually by the members of a company to manage the company on their behalf. The term director has no specific meaning, but is defined under section 2.1 of the Companies Act as follows. Director includes any person occupying the position of director by whatever name called. Accordingly, a director is recognized not merely by his or her title, but principally by his or her function, which depends on the nature of the company. A person requires no formal qualifications to become a company director, although I would say that most company directors now are upskilling where possible and getting courses. There are a number of good courses. There's out of UCD, there's the corporate governance course, the Institute of Directors do courses on a regular basis. So, going back to that ongoing training, I would recommend, you would expect me to say, to keep your gunfighting skills good and keep your training up. But that said, you require no formal qualification to become a director. The Companies Act requires a company to have at least one director. However, most companies, other than limited, are legally required to have at least 2 directors. So let me just go back to that for a sec. So eligibility. Before a person can be appointed a director of a company, the company must ensure that such person is eligible to hold the position of a director. Certain parties and persons are ineligible to hold office as a company director. And this would be the same in the Code of Governance, which we would see, it's almost mirrored. A body corporate or an incorporated body of persons, a person who is under the age of 18 years, an undischarged bankrupt, the statutory auditor of the company, a person disqualified from acting as a director by the courts. So the legal categories, and this first one is actually the one that often comes up, shadow director. So any person other than a professional advisor, in accordance with those directions or instructions the directors of a company are accustomed to act, is a shadow director. A shadow director will be treated as a director of the company for the purposes of Part 5 of the Act. A de facto director is a person who occupies the position of director of a company, but who has not yet been formally appointed or is qualified, but who in effect occupies the position of and acts as if he were a director. Such persons, although not formally appointed for the purposes of Section 2.1 of the Companies Act, will be treated as a director of the company. And then alternate directors. Now, this is actually something that's come up a bit in recent times. A director of a company may appoint any other director of the company as an alternate director, or with the approval of the majority of its directors, any other person as an alternate director. Any appointment as an alternate director will be effected by notice in writing given by the appointer to the company. Now, where that's come up recently is with the pandemic and COVID and so on, particularly in the financial side of the house in terms of organizations, where they may have a concern that someone could get COVID, a director could get COVID and could be out of commission for a period of time, God forbid. So just to kind of protect the fluidity of the board and the ongoing commission of the board from an efficacy point of view, they have been appointing alternate directors. The principle applies, I think, in politics as well, where you would see, I think, I could be wrong, in terms of MEPs, I think they sometimes appoint an alternate. that mechanism there is not 100% sure on that. So, but in any event, the alternate directors is one we're seeing a lot of in the corporate space at the moment, where there is a prudence has been observed in terms of just ensuring the ongoing efficacy of the board if people go down during the period with the unfortunate affliction that an alternate director is in place to take up the strain fairly handily and fairly sharply. So obviously you have managing directors or CEO. The director of a company may from time to time appoint one or more of themselves to the office of managing director for such a period. Now that happens sometimes where there's an interregnum where a CEO for whatever reason is stepping off deck, and the board appoint someone from within their own body to on an interregnum basis step into the post to ensure that there is command and control of the executive team. Not ideal. Wouldn't recommend it for anything other than the short-term period, but it does occur on an occasional basis. The executive directors are directors of the company who are involved in the day-to-day management of the company. That's again more in the corporate and commercial space, not so much in the this particular space. And non-executive directors, which is yourselves, are not involved in the day-to-day management of the company and are appointed from outside the company. The rationale behind appointing non-executive directors is that they are not involved in the day-to-day management of the company and that you can bring an independent voice and perspective to the board. So you fall into that last category as non-executive directors. So your role in terms of your duties and responsibilities. So I'm just going to take a drink of water for a sec, if you can just allow me. Excuse me. So company directors' responsibilities are wide and diverse, and your duties arise primarily from two sources: statute and common law, I guess the Acts of the Erectus and other legislation. So a director in appointment consents to the role and signs a statement to the effect that I acknowledge that as a director I have legal duties and obligations imposed by the Companies Act, other statutes and at common law. Now in your own instance you would get a letter of appointment from the minister and that would outline their expectations in that letter of appointment. I'm guessing you would all have got that letter, and that's the standard practice in terms of state bodies. Now, as the vast majority of Irish companies are private companies, there are a substantial number of companies of which the directors and members are one and the same. Under such circumstances, the distinction between the company's property and the director's members' own property can be a matter of some confusion, with the result that the directors treat company property as though it was their own. So not a good thing. A company director stands in a special relationship to the company of which you are an officer. This special position is known as a fiduciary position, and the director is known as a fiduciary. And that even is more kind of clear in terms of special, I suppose, skill sets. So, for instance, the fiduciary knowledge of a chartered accountant might be judged as higher because of the aforementioned knowledge, specialist knowledge that they would have, as opposed to someone who didn't have particular knowledge in that space. And the fiduciary is required to act in a manner which is legally becoming of their office and which places the interests of the company ahead of their own at all times. And that is a mandatory baseline requirement. So the principal fiduciary duties of a company director are owed to the company and the company alone. In law, it is regarded as the highest standard of care and trust. The principal fiduciary duties are to act in good faith in what the director considers to be the interest of the company, to act honestly and responsibly in relation to the affairs of the company, to act in accordance with the company's constitution, and always good every now and then to kind of reread the constitution of the organization, exercise the powers that are vested only for the purposes allowed by the law, and not benefit from or use the company's property, information, or opportunities for his or own or anyone's else's benefit, that conflict of interest that we touched on earlier. And to avoid conflict between the director's duties to the company and the director's other interests. Exercise the care, skill, and diligence which would be reasonably expected of a person in the same position with similar knowledge and experience as a director. A director may be held liable for any loss resulting from their negligent behaviour. And again, we would say as something that's very important and to all boards is to make sure that your insurance policies are up to date and in place in terms of professional indemnity policies, and no harm just to ask to see a copy of those every now and then on an annual basis, or to ask the executive to give validation and proof that they are in place and that they're in good order. But I would commend any board, anyone that's serving on any board, just to make absolutely sure that those protections are in place. So, director's statutory duties as a company officer. So it is the duty of each director of a company to ensure that the Companies Act is complied with by the company. An officer is in default if he or she is in breach of their duty as an officer of a company or authorises or permits a default to take place. Where a director answers a question, provides an explanation, makes a statement or completes, signs, produces, lodges or delivers any return, report, certificate, balance sheet or other document that is false in a material particular, and he or she knows that it is false or is reckless, they're in breach of the Act. That's why I guess minutes are important, and that they accurately reflect what is the decisions that have been taken, that the annual report and the figures contained are accurate and stress tested, and that you have a robust mechanism to give yourself assurance that everything is as it should be. Where any officer of a company destroys, mutilates or falsifies or is privy to the destruction, mutilation or falsification of any book or document affecting or relating to the property or affairs of the company or makes a false entry in any such document. Where an officer of a company fraudulently parts with, alters or makes an omission in any book or document affecting or relating to the property or affairs of the company, or party to the fraudulent parting with, fraudulent altering or fraudulent making of an omission in any such book or document, they are in breach of the Companies Act. You have a duty to keep adequate accounting records. And each company is obliged to keep or cause to be kept adequate accounting records. It is a criminal offence for any director of the company to fail to take all reasonable steps to ensure compliance with this requirement. I'm aware of my audience, and I'm sure you're all very much aware of these things, but it is a belt and braces exercise. So for the avoidance of doubt, I just want to go through that. So you have a duty to file certain documents with the Registry of Companies. And again, these are, just to go through them very quickly, your annual returns, if there's a change of the registered office, notice of alteration of increase or decrease in share capital, notice of increase in nominal authorised capital, change of directors, the B10s and our secretary of their particulars, notification where a person has been authorised to bind the company, notification where a company fails to send prescribed form to the registrar that a person has ceased to be a director or secretary, nomination of a new annual return date, notification of the creation of a mortgage or charge, a memorandum of satisfaction of charge, and ordinary and special resolutions and agreement. So the boards, your board, the collective responsibilities that you have. So you have to meet regularly. You need to develop coherent decision-making processes and get results. You need to set long-term goals and ensure effective planning strikes a balance between the short-term and longer-term health of your organization. You need to have the final say when determining yearly objectives. You need to confirm policy, ensure it's up to date, and ensure the mission of the organization is adhered to and is highly mission-focused. You're required to finalize budgets and ensure that the allocation of funds is appropriate and within the resources available. You need to maintain the board's health, appointing new board members, evaluating the board's performance on a regular basis. You have to take ultimate responsibility for all legal matters. You need to take ultimate responsibility for compliance with regulatory requirements, so the AGM, timely returns, etc. And also the appointing of auditors and approving the audit of the financial records via the AGM. You also manage subcommittees. So your own individual non-executive director responsibilities. So you have to prepare for and participate in the decisions, discussions, and business of the board. You need to foster a positive working relationship with other board members and staff. You need to be aware of and abstain from conflicts of interest. You need to declare all potential conflicts of interest. You need to be assured that management succession is properly being provided. You need to review compliance with relevant material laws affecting the organization. You need to undertake board development and training as opportunities arise. You need to be accountable to the funders for programs and services provided and funds expended. You need to monitor and evaluate the effectiveness of the board through a regular review of programs and services. And you need to provide candid, constructive criticism, advice, and comment to the executive in a healthy way. Ethical standards of behaviour. You need to comply with the codes of practice for the boards. You need to include declarations of interest, conflicts of interest, any hospitality, gifts, travel and entertainment, as per the policy of your individual board. They all differ and they all have certain thresholds. Just be mindful of whatever they are and if they apply. Ask the company secretary if you have any doubts about that. Accountability and openness. You need to arrangement for directors' remuneration and expenses are appropriate. You need to make sure that training and development plans and opportunities are in place. And you need to submit to performance and appraisal arrangements. And you need to have procedures for expressing concerns, whistleblowing, who to approach in the first instance. Most boards now would have a nominated go-to person, independent person for the staff among the board. That is the nominated person. It mightn't necessarily be the chair in the first instance. It could be an independent non-executive director that if the staff feel that they can't go to the executive, we have cases where there has been issues that the executive actually were the receivers of the disclosure, and accordingly staff had an issue in terms of who did they talk to if the people that they're complaining about is the executive. So therefore the way around that is actually have someone nominated on the board as the nominated person, and we're seeing that as a regular occurrence in boards now, and that can be recurring, just not to load the burden on anyone for a longer than necessary period of time. It may be that person is nominated for a period of a year or such. So you need to have a commitment to the mission, vision, and values of the board. You need to buy into that. And you need to be aware of what they are, and you need to, refresh your knowledge of what the board is about on a regular basis and the services that it provides. You need a willingness to actively participate on at least one committee. It goes back to that time element of the equation. It is a big time resource, personal time resource. It is effectively, although there is some remuneration, I think relative to the amount of time that people put into public service boards, it is a public service, but just be aware that there is time and that you have to manage that and not overexpose yourself. And if you feel that you can't give it the time, well, then maybe you should step back and consider your position on the board. You need to attend at the annual general meeting. You need to be informed of the board's services and programs. You need to prepare for and participate in discussions and deliberations of the board. Now, that doesn't mean that you need to have an opinion on everything. It's okay not to have an opinion on everything, but you need to listen actively. I think probably one of the key skills that a board member has what I would describe as aggressive listening. God gave us one mouth and 2 ears, I think is the old adage. So I think one of the key skills that all board members bring is their that attribute of aggressive listening, that they seek out to explore and listen to what's been said, percolate, ponder, reflect on what has been asked, and then come back and ask questions if they don't fully understand or they wish to explore it a bit further. It's okay not to have an opinion on everything all the time. You do need to contribute regularly, and it's the job of the chair to make sure that they elicit appropriate response across the board from everyone, that satisfy themselves that everyone is engaging such as sufficient onto their standing. And that's I suppose a good chair will do that and ensure that everyone has a healthy opportunity to contribute such as they wish to. But it is important, notwithstanding that, you cannot sit there idly by and never contribute. You do need to contribute on a regular basis, but you don't have to contribute to everything, is what I'm saying to you. So the key roles. The chair, as leader of the board, is absolutely critical, and it's a primary role. And the chair's role is to provide overall leadership to the board, set that tone at the top in terms of the direction ethically that the board is going in. And it's the board's chair, his function or her function is the principal link between board and the CEO and management team. That relationship is critical. And it's very important that there's a healthy relationship there and that they work seamlessly together. It's not always the case, because human nature being what it is, you can have clashes of personality often. So you don't have to like someone to work with them, but you do have to be able to kind of park your personal kind of issues and just get on with the mission at hand. And I think, generally speaking, the relationships that we come across are fairly good, and people are very professional in how they go about it. But sometimes you can have erosion of trust where that particular relationship can be challenged. and it's something for the board themselves always to be mindful of. And indeed, on the annual review that you would do, one of the metrics that you are asked to kind of give judgment on is that particular element of the relationship between the CEO and the chair and the management team, and how that relationship works from your point of view. So that's a stress test, if you will, kind of an alarm bell out there that affords people the opportunity just to flag that they may or may not have a concern. Generally, people are quite happy, but that mechanism is there within the annual review process. So the chair is responsible for the board agenda and the work plan, and to work with the board committee chairman and chairwomen, and is involved in selection and induction of new directors. And again, it's the chair's role to ensure that they're happy with the induction process, that it's fit for purpose, it's detailed enough, and that it spans the particular nature of the endeavour of the board with such detail that any incoming board non-executive directors are sufficiently briefed to hit the ground running. And again, that's an ongoing thing. Look at best practice and look at where I suppose the induction kind of skills and augmentation are needed on a regular basis. Also, the relationship that the chair has with individual directors on their performance is one where he needs or she needs to have an occasional soft word if their performance kind of and their contribution maybe isn't up to scratch, just a flag that they'd like to see a bit more contribution, or indeed to elicit if they require any particular augmentation in terms of training, and to endeavour to make sure that that's provided for them in a timely fashion. And as required to participate in discussions with investors and key stakeholders. In this instance, it would be with the meeting with the minister, which most state boards would have once a year, and ongoing meetings with the SecGen of the department, such as they're required. All boards are a little bit different to how to go about that. Generally speaking, the chair would report back on those meetings. Either they can be minuted from a transparency point of view, or he can just or she can give an update to the board. But it's important that they give a feedback in terms of stakeholder engagement, how they got on, if there's any issues being arisen, what the minister in this instance is looking for moving forward, or the department, for example. CEO. Again, the other part of the pyramid, and the CEO's role is to lead the management team and report to the board. So their function is to work closely with the board chairperson and is responsible for the performance of the management team and make sure that they're delivering, to formulate and deliver on the strategy and the annual business plans and the budgets. They're responsible for the corporate and financial objectives and delivery of same, to formulate major corporate policies, to ensure continuous improvement in services and products, to manage relations with investors, major customers, stakeholders, the department, and so on, and to responsible for the company's long-term sustainability. And also, very importantly, responsible for the health and safety of the staff that they are responsible for. And that's a very big one at the moment. And one, again, that we're seeing coming up as a specific item on most agendas, just to touch on. The COVID, for example, we talked about committees. I should have said a lot of boards at the moment have a COVID committee or a pandemic committee, which is an ad hoc committee specifically addressed to reporting to the board on the performance of the executive in terms of, for example, health and safety issues pertaining to the staff during the time of the pandemic. So that's a subcommittee that's a lot of boards would have in place at the moment on an ad hoc basis. So the company secretary, you may or may not be familiar, a very mission critical role as well. And their main statutory duties include signing the company's annual returns and certifying the financial statements, disclosures, information, and so forth, making out statements of affairs in the winding up of the company, which is obviously a case in state bodies generally. And the main admin duties will be keeping the company minutes of meetings, and they are mission critical, keeping and making available for inspection the company's registers, such as register of members. And also, they would also keep the register of interests, which are required as well, of member interests. And communicating with the company's members, for example, as you would have got a notification today about this particular meeting, that they give you timely information in advance of all meetings, and populate the corporate agendas as required, and making sure that they're up to date and that you're fully informed on anything that you need to be advised on. Senior management, they're responsible to you for providing accurate, timely and relevant information to the board. They need to support the board's planning function, determine the needs of staff, owners, stakeholders. They need operating programs and reporting on those outcomes, those key performance indicators. They need to evaluate performance of their staff and manage stakeholders and staff, and implementing your decisions as they cascade down to them. Again, financial operations, daily operations, being mindful and using the resources of the assets of the organization carefully and prudently, discussing ideas and forming long-term goals, strategies, again, designing the programs to achieve your mission as you lay it out as the board, ensuring risk management programs in place, very, very important that they have robust frameworks, and we'll deal with that in a few minutes, and ensuring the achievements are noted and documented. So again, that you get that reporting structure coming back to you. And promoting the organization. Goes without saying that all organizations need the oxygen of a little bit of positive PR out there. So it's their duty to make sure that you're front and center and getting due recognition of the good work that you're doing. Board evaluation and review. That's a mandatory requirement in terms of the code of practice for the state bodies. It's twofold. You do it annually now, and then you do a big one every 3 years. We would generally say that a lot of organizations do the big one first, just to lay in a baseline, a benchmark. And I would obviously say Governance Ireland are specialists in that, as you'd expect me to. But I'm you know, that's standard par for course. All state bodies are doing this, and it's a healthy exercise to do, and you should engage with it from a point of view is that it allows you reflection time. It allows you to step back and have a think about where you are in terms of the relationship with the CEO, your culture and dynamics, if it's healthy from your perspective, if there's any red flags that you want to raise a hand over. It brings you through about, you know, quite a number of different sectors which are mandated, and it affords you the opportunity to raise your hand on a confidential basis from a collective perspective, which will be then fed back as a generalized report to you in terms of the findings. And that will, I suppose, give you or give the company secretary a job of work in terms of corporate governance efficacy over the year ahead. And again, the bigger one is done face-to-face, and they involve interviews with each of you, and that will elicit your views and concerns and your aspirations and where you see the future opportunities for the board. And it's a very potent thing, and I think it's very healthy. And I think a lot of people now are getting on board as opposed to a box ticking exercise that they need to do, and looking at it as a positive contribution to the overall health of the organization. So again, all these things are reviewed within the context of an evaluation snapshot in the minutes to make sure that they're up to date in terms of best practice, terms of reference for subcommittees, reserved and delegated powers to make sure that they're being reviewed on an annual basis, skill sets mix, which I've mentioned earlier, relevance and competence and board composition, diversity. So there's a stress test done to give yourself assurance that you're fit for purpose and that you're operating up to best practice levels. Tenure, rotation, succession, generally kind of preordained in terms of state boards because of the nature of the appointment process, and that the committees and organisation and processes are fit for purpose. So again, I'm not going to go through that in any great detail, but that just gives you a snapshot of evaluating your board and the different four elements of it. You have the board structure review, the board's role in governance, financial reporting processes and internal risks, the management of same, and then the dynamics and functioning of the board, I suppose the healthy engagement that you have when you're together and operating fluidly. So appointing directors and board composition. I'm just going to take another drink for a second. Excuse me. So usually through nominations or governance committee, but not in this instance because you were appointed by the minister, and that process comes to two channels. You will have the public appointments process where a call will go out through the department via state boards that they are looking for applications for members of a state board, and people will apply to that process, and that will be filtered then in terms of the process, which ultimately a committee will be brought together to review the applications, and they will make recommendations to the minister, normally depending on the appetite of the minister, between 3 and I've seen 10 go forward, but generally three candidates are progressed. And that has to be mindful of diversity issues as well and the composition of the board as in play. So that's one. And then you have I suppose the other element of the equation in state boards. Most state boards have worker directors. So that's an electoral college where it can be, for instance, a union-based one, or it can be just a general cross-population voting prospect, and it depends on the number. It can be from 4 to 2. And a lot of state boards are different in terms of the size and scale. So those are the two. And sorry, there is a third element. So in some occasions, state bodies, you have a vested interest nomination. So you might have someone like IBEC, for example, or one of the professional bodies, whatever that would be, may have a nomination on a particular body. They're not so common, but there are there, and IBEC may nominate someone from their particular membership, or you could have someone from the medical profession or whatever it is on a particular board. So that's the third one, but not so common. So a checklist of considerations when recruiting new board directors. Now this is general, I would say, as opposed to specific, and it goes back to that point I made earlier, that the chair should probably look at on, I suppose, the skill set composition of the board. So your ideal candidate moving forward. Not to say that you don't have an ideal board in place, but all boards are living entities. So people step off and come, go away and their tour is up or whatever. And the unique skills that they bring need to be replenished. And sometimes, as I said to you, digital skills are not something that a board would have been looking at 5 years ago. It is something that they need to look at now. So, it's just where we are, and they need to be evolving. So you need to establish an ideal matrix of skills, expertise, and backgrounds, and recruit new members to fill those gaps as they occur. And that skills audit we've been talking about is something that the current board membership needs to do on a regular. I would say a skills audit is probably done once every 3 years, and that's probably adequate. But it is important to do it, and it can be done within the context of a board evaluation. So you can actually catch it in that space as well. If you just ask the evaluators to actually insert a series of questions in terms of a skills audit element to the equation, that's one way of doing it as well, which can be handy. And you need to produce role descriptions for new members so that they, I guess, are unambiguous in terms of what their expectation is when they're joining the board. And that goes back to that induction process as well. We did a board evaluation there recently, and the time element of that particular board was unchristian because they had a quasi-regulatory element to their deployment, and the fitness to practice subcommittee was basically almost a full-time job, which some members hadn't given due consideration to when they became members of that board. And the time element had become, seriously concerning for them, to the point where they were actually thinking that they may have to step off. So no surprises in terms of time commitment, and be aware of what you're getting into in terms of the criteria of what the expectation are. Board meetings. So one of the main responsibilities of the board chair is to conduct successful board meetings. And again, the ideal board meeting is that where everyone leaves feeling that, I made a contribution there. By my presence, it mattered, and I asked the right questions, and I feel that was a good, positive, productive board meeting. That can be said of any meeting, but particularly for board meetings, that's what the chair seeks to achieve, generally speaking. So at the start of the year, the chair will develop an annual agenda derived from the board's strategic priorities, and he'll establish a clear purpose for each board meeting to decide, approve, or receive information for each item on the agenda. And they do that with the SEC. And prepare agendas with priorities and place important items first on the agenda. So again, the agenda is reviewed before each meeting, and matters can come on the agenda. So for example, I would say that the recurring risk item on the agenda is one of interest sometimes, where you can take an item from the risk register and do a deep dive on each particular one. But again, clearly the pandemic came upon us last March, and that must have jumped on the most board agendas pretty quickly as well. So again, Board agenda shouldn't be static. There should be static items on it, but there should be sufficient flexibility to allow other items on the agenda to drop off and come on as they are important. And you need to, the chair maintains focus during the meeting, and this is self-evident at the moment. We're suffering from Zoom fatigue, and it's particularly challenging in an environment like this where we're dealing virtually. But nonetheless, it is important to try and maintain your focus during the meetings. And while the chair runs the meeting, the entire board shares the responsibility for keeping the discussion on track. So it's often said that the perfect board doesn't really go to voting, that they strive for consensus, and that generally is the way of it. Votes are probably the last resort of an active board, because they can get to a point through their deliberations and stuff like that a vote is not required. Sometimes, however, it is, and such is life. But the chair and a good chair will strive for consensus, and that there'll be a meeting of minds. And there may be an element where there's a little bit of give and take in terms of the ultimate decision that's taken, and that's the art of compromise. And not every decision will be unanimous, but the more decisions that are arrived at through discussions and consensus, the better the chances for long-term success. And to seek completion of each item. So you need to make sure that everyone is clear on the implications of decision. What are the next steps? Who is responsible for taking what actions? The next update. I think it was Churchill that said that strategy is really important, but equally important is to actually check that the strategy is working every now and then once you've taken it, to revisit the strategy in terms of what you expected from it, and has that been delivered. So from a chair's perspective and from your perspective as well, are you happy with your agenda? And is the agenda, which is the blueprint for the meeting, is care being taken in designing the agenda? And will the meeting accomplish what is intended? An agenda provides an orderly way for the board to accomplish its responsibilities. Typically, the CEO and the chair prepare the agenda after providing opportunity for board members to request that certain items be included. Board members should receive the agenda prior to the meeting so that they have time to prepare a few days' notice, which gives them time to read supporting materials and prepare for their part in the meeting. Best practice is normally 5 working days at a minimum. The 48-hour rule also applies generally on state boards, where documents coming within 48 hours may be sent, but decisions are not generally taken on them. Obviously, there's exceptions to the rule if it's catastrophic that a decision needs to be taken urgently, but generally the 48-hour rule would be that they're for noting at the next meeting, but that 5 working days generally are given before decisions will be taken on documents that are submitted. Again, I would say that circumstances being what they are, on occasion, you may have to stretch that rule a little bit, but it's by exception. So a typical agenda will include the following items: date, time, place of meeting, agenda items and desired action for each item, whether it's for information, discussion, or decision, the persons responsible for each item, and the time allocated for each item. Again, one of the difficult challenges of a chair is to actually keep the meeting running. It's no easy role to be the chair in terms of delivering a meeting within a particular time. It's a great skill and one to be admired, and also to allow people to contribute in a meaningful fashion, but at the same token, keep the agenda moving and delivering it within a reasonable time frame. So a typical board agenda should encompass at a minimum legal and regulatory updates where applicable, the risk review, any other business. At appropriate times of the year, the agenda should also cover periodic processes such as budgets and financial planning, annual external audit processes, and to ensure that their effective board meetings should stick closely to their agenda. Strategy clearly is one of the big ones in that, and most board meetings would have one dedicated to a board strategy review on an annual basis. That often coincides with an annual away day. Mind you, in the current environment, it remains to be seen when we collectively will come together on an away day, but you can have a virtual away day, I suppose, if we can come to some meeting of minds how that could work from a corporate point of view, perhaps get the same takeaway to deliver the same food, so you have a communal meal or something like that. So it equally should reflect the minutes of the previous meeting, that they're proposed and seconded, strategic updates as required, current trading conditions, marketplace parameters, update on major issues out there, operational updates, high-level details of the performance of the company's products or services in your own case, The financial update focusing on the company's KPIs, the management accounts and financial reporting, very important, and cash and financial updates and covering cash flow and financing. I know one charity's board where they actually asked to see a copy of the bank statements once a quarter, just to assure themselves that the actual reporting is accurate, and they look for a hard copy of the statements from the bank. So, how far do you go? I think there's a limit to what you can ask for in terms of documentation as well, and the time that's available, but you can ask for anything within reason. So standards for board meetings. It needs to be run in a fair, open-minded, professional and orderly fashion, and we take that as read. That the agenda is well designed by the board and the chair and the CEO, and that it's convened before meetings to clarify agenda items and anticipate problems that may arise. And that is the role of the chair and the CEO to kind of navigate that in an orderly fashion in advance. That the procedures for the board packages received by the board members in advance are in place. I'm guessing a lot of you will be getting these virtually at this stage, and a lot of boards have transitioned over to virtual platforms in any event in terms of their board papers, as opposed to getting hard copy. But you get a hybrid model with boards getting hard copy in some instances. Most boards, though, are getting virtual copies now, and a lot of them will be issued with iPads or laptops to facilitate that. That the board sticks to its agenda, and the board chair keeps the members on task. That each member is given an adequate opportunity to participate in discussions and decision making. And again, these are the standards that we aspire to and that we'd expect. And that the board members relate to each other in a courtified, dignified, fair and ethical manner. And the board always bases decision according to its mission. Always be mindful of what you're there for in the first instance, so that you have a touchstone to go back to. If you're making decisions, just that it's fit for purpose, that it coincides with your mission and vision, and that it's you can stand over it from a transparency point of view. Why did I make this decision? Well, because it was very much vested in the role and the purpose of the organization, and it delivered on that progress that we're making. So once met, board members support the decisions made by the board, and even if they disagree during the discussion, it's a collegiate exercise. So tease out the questions that you have before the decision is made. Satisfy yourself that you're happy with the answers that you get. But once you make the decision, stick with it. And you also need to recognize that you have no individual power and you operate collectively. And standard procedures and bylaws are followed. Board minutes are kept in an organized minute book. They should start on time and adjourn on time. Board members arrive at meetings on time and stay until the meeting is adjourned. Board members read their agenda packs and prepare before the meeting, and that you adopt written policies and procedures for conducting board meetings. And the board defers action on items not on the agenda until they can be studied and discussed. As I said to you, that is something to be mindful of as well. So conflicts of interest. And a conflict of interest is a situation in which a person or organization is involved in multiple interests, financial or otherwise, one of which could possibly corrupt the motivation or decision-making of that individual or organization. Now, conflicts of interest is a big one in the Irish context, and certainly over the last 2 or 3 years has become one that most boards would be briefed on and mindful of, but yet it is tricky because Ireland is Ireland and everyone knows everyone. So it is something to give due consideration to. And ultimately, a conflict sits within your own mind. If you have a conflict, it's up to you to decide whether you have a conflict. It's not up to someone else to tell you you have a conflict. They may perceive you have a conflict, but it's up to you to bring that to the table if you feel you have a conflict of interest. And as I said to you at the outset, the fact that you know someone doesn't necessarily imply that there's a conflict of interest, but your protection from that, from your reputation point of view, is to have transparency, and you can flag it. So you can flag that you know someone, or someone is a second or a third cousin or something like that. And that's fine. And then the chair will make a decision whether, if you feel yourself that you're unclear whether you have a conflict of interest, but you flag that you have the relationship, the chair then can actually decide whether they're comfortable with it. But the important thing is that people are aware. Where you come a cropper on this is where people suddenly discover afterwards that you have a relationship, or that you have a material kind of connection with something or an entity or whatever that you hadn't flagged. Transparency is the order of the day. One see, they all see. So handling a conflict of interest. So is there an interest? So clearly spouses, relatives and friends, and friends can be a broad church, you know, and it may or may not be an interest registered under your code. So you need to be just aware of what is and what isn't. Is that interest material? Would a member of the public with knowledge of the facts and acting reasonably consider the interest likely to harm your ability to judge the organization's interests? So again, I go back to that Joe Duffy scenario. So if Joe was asking you the questions, would you feel comfortable that, you know, you could answer them in terms of in layman's language, that that relationship was okay, and that you felt that you could park that in your mind and it didn't bring to bear any inference in terms of the decision you made, because you made it independently and you had set that knowledge aside, and that you had flagged it and that you had admitted that you had it flagged. In cases of doubt, clarification can be obtained in advance of the meeting, and that's where you know your relationship with the chair and the SEC is important. And you know, as I say, it's very common to have conflicts of interest. Transparency is your way out of that, and we would say that is something just to be kind of always careful on. So how do you handle a conflict of interest? Well, if it's material, declare interest and withdraw. That's it. There's no ambiguity on that. If you feel that you've got to, you know, if your sister is running a company that's, you know, doing a tender for the organization that you're making a big procurement decision on, well then, on the balance of probability, you've got a material interest, you should declare your interest and withdraw. All financial interests are prima facie conflicts. If you've got a shareholding, or you've got a financial position in a company that's tendering or whatever, well, you've got a conflict. It's not so if the interest is so remote or insignificant that a reasonable person would not see it as likely to affect any influence. So, you know, if it is generally known that you have that position and the chair becomes aware of it, the chair then regretfully sometimes has to intervene and kind of point it out. And that's from a reputational point of view. You don't want to be going down there, you know, cauterize it, get it done, have it flagged in the first instance, and just have it squared away. It's I suppose good housekeeping from your own perspective. Just keep it in the back of your mind. It shouldn't overburden your thought process, but just be mindful of it. So again, I would say to you, discuss with your chair, declare at the outset or as soon as reasonably practical. I mean, you will have read your minutes and you will have read your agenda beforehand, so you will know these things are coming up. So, you know, you have the opportunity to declare beforehand and deal with the matter. And again, for your own protection, disclosure should be recorded in the minutes. And that is for your protection as much as the board's protection as well. You've only one reputation. You know, it takes 20 years to build it up. It could take 5 minutes to lose it because of just some housekeeping in terms of not getting these things in place. So, from a material interest point of view, you should not get involved in the setting of criteria for the award of grants tenders. You should not be on a grants committee if they're significant or habitual recipients are likely to be. You should endeavour not to get involved in the preparation of bids or interact with staff after the award. You should not receive papers relating to their application in advance of the meeting or minutes afterwards. You should be absent from the discussion and decision. You should not use your position to try and influence improperly the decision in your absence. And no comment inside or particularly outside the meeting. Your conduct and actions must not bring the organisation or board into disrepute. You cannot give approval to suppliers without the authority to do so. When nominated to another organisation, observe both codes of conduct. Avoid appointment to similar type organisations if at all possible. If nominated as a director of a company, you have a personal and fiduciary responsibility under company law to that company. You must not use position on the board to promote private or company interests or to secure privileges, exemptions for themselves or others. You must observe rules concerning conflicts of interest and confidentiality and not leak information that is confidential or obtained through privileged access. So procurement and contract management, and a lot of this came out of the procurement side. Again, if we look at the lobbying provisions as well, where a lot of it came from property and that side of it as well, is another side of the coin in terms of I suppose, rules and regulations in terms of lobbying, which we haven't touched on in this, but I would say that you should need to be briefed on the implications of the Lobbying Act, and that you if you are engaging with someone on behalf of the board who is a nominated person, you need to advise the SEC that you had that engagement, and the chair then needs to deliberate whether that is in your annual returns in terms of the lobbying provisions. We can talk about that later. So procurement and contracts management, you can comply with procurement regulations, and tendering or grant making procedures must be robust and best practice. Beware of single supplier tenders. The three tender rule generally applies, and that's a good rule of thumb. Beware of split contracts to avoid tendering thresholds, and avoid becoming obliged to or appearing to become obliged to a supplier. So avoid inappropriate use of public monies. The watchwords are modest and appropriate. Most public tenders have value for money as the most points go in that particular space, and that's standard practice. I mean, could you stand in front of Joe Duffy or a member of the public and feel comfortable defending the expenditure? Be conscious of the current economic climate and sensitivities. For exceptional cases, make a sound business case setting out the benefits. Take particular care over expense claims. Now, you know, I would also kind of instance unusual circumstances. Clearly, the HSE recently there with the hand washing gel issued a contract beyond tender. These were exceptional circumstances. So there are exceptional circumstances. Whilst undesirable, they can be explained, but just have your explanation if they are exceptional. And the word exceptional is the key takeaway there. They should not be regular. They should be very, very exceptional, and preferably not at all. And again, it goes without saying, take particular care of your expense claims, because that is one where freedom of information sometimes are, I suppose, people kind of, these are minor things, but just be mindful of them, just to make sure that your T's are crossed and your I's are dotted. State boards have a particular challenge in terms of conflict of interest and conflict of loyalty. And I suppose what I'd say about that is you have a conflict of interest, which we've dealt with, but you sometimes have a conflict of loyalty. And that applies to if the state board has, for example, a couple of directors who are nominated through the electoral college process. And human nature being what it is, it can be difficult on occasion if you are coming as an elected representative of your union or of your fellow workers who you're working with on a daily basis, to maintain that separation of the board deliberations and you know, your day-to-day engagement with your fellow colleagues. And they may have a set of criteria and agendas that they wish to promote and promulgate, and indeed which, you know, you may have canvassed on to get you where you got to in terms of your board appointment. However, once you go through that door shuts firmly behind you, and you are sitting at the board as an independent director. So you have to be absolutely clear that anything that went on before in terms of how you got there, in terms of the electoral process, has no meaning or impact in terms of the decisions that you make as an independent director. And to that end, you know, this is a particularly sensitive one in regard to health and safety, but also in terms of employment issues. So, for example, a state board may be deliberating on redundancy programs, for example, or headcount reduction, or they may be looking at locational augmentation in terms of reviewing particular deployments in, say, Galway, Mayo, Cork, Donegal, or whatever the offices may be looking to close there or whatever. So that information remains highly confidential to yourself if you're in that category, and you cannot discuss it, and not that you would, but you cannot discuss it outside the confines of the board, because board confidentiality is absolute. And your duty of care as a director is to the board and to the greater good of the board, and not to the, I suppose, to the element from whence you sprang. So what is not clearly probably not an issue on your own board, other boards, particularly in commercial semi-states, where you would have very, very big electoral colleges, and all the unions, for example, you may have 4 unions, all having their own electoral college, and they run a very big process, and each having their own particular agenda, and they may have their own particular kind of divisions, and all have conflicting agendas and requirements, and that person can come under fairly intense pressure from his constituency or her constituency. So it's just one to be mindful of the conflict of interest, but the conflict of loyalty is unambiguous. Your loyalty is to the board in the first instance and the final instance. So as I say, just as this is a state board, we reflect on that accordingly, and there is no ambiguity. First, second, third loyalty and last loyalty is to the board and to the board alone. So the board's role in strategic leadership. So, you need to be future focused, and your primary mission is, of course, strategic. And it's also important to remember that, and tease out that you're giving enough time and thought to discussing strategy as opposed to tactics. And most of your time should be spent in that area. You need to have an awareness and understanding that the organization operates in a fast changing marketplace. And, the pandemic is a case in point. It has evolved very quickly, and we've had to pivot very quickly, and organizations have had to move very quickly in terms of how they go about the commission of their business. You need to have an acceptable risk-taking appetite, and you need to balance the need to take chances with the traditional stewardship of the state model and the responsibilities of I suppose, the service that the board is giving moving forward. Traditionally, state boards would be risk, and certainly the risk appetite would be very low. They're risk averse, whereas modern organizations need to have a degree of risk embedded into how they go about their thinking within reason. The stress testing that you could, I'm not saying totally, you're not into kind of mining, but you need to have a risk appetite which is reasonable. And you need to demonstrate sound strategic decision-making in partnership with staff leadership, utilizing the planning tools that are available to you. And you have to communicate the strategy widely so that, everyone in the organization knows what the strategy is and that they've bought into it. And that goes right across all the board. It's very important that from the person answering the telephones to open the doors to the senior executive team, if you ask them, they would have a sense of what the board is about and what you're doing and what you're delivering. That is an important takeaway that, you can dive into anywhere in the organization and ask anyone, are you comfortable, what our strategy is? And they should have a sense of it, because that communication needs to be fluid throughout the organization. And you need to find the course of action that will exert the highest leverage of your assets, that the budget that's being given to you, you get the best return on investment there. And again, as we're in this space at the moment, you need to look for creative ways to connect the organization to the world around you. Exploring and imagining new forms of partnership and alliances that will support the mission and advance the strategic plans. Risk oversight and understanding risk management in practice. So most significant risks facing the company, you need to evaluate them and the possible effects on shareholders and stakeholders and the company's management of a crisis. And again, the importance of stakeholder confidence in the organization and communications with key stakeholders. And that's what the board should know about and evaluate. And that's the business in terms of the essence of what you're doing in terms of risk and risk management. You should know most significant risks facing your organization. Certainly you should know the top 10, and you should know what keeps the CEO awake at night. And that's always a good question to ask sometimes, in terms of every now and then ask the CEO, what, from an organizational point of view, what's keeping you awake at night? Always a good question to just touch on every now and then. And the possible effects on the I suppose, the department or the minister or the owners in terms of the risk and the decisions that you're making. Company's management of a crisis. How do you go about your management in a crisis? A classic example over the last couple of months and since March, how did the organization deal with the crisis? Did you have a plan in place? Were you able to pivot quickly? Are you comfortable that, you're appropriate to, I suppose, the response at this time? Is there sufficient resources being made available to ensure that moving forward that the response is appropriate? And communications with key stakeholders, particularly at the moment, is very important as well. One of the I suppose the rules of corporate governance is that nature abhors a vacuum in terms of communications. So it's important just to keep an ongoing line of communication with those stakeholders that you're engaged with. Silence is not a good corporate position to take in terms of a crisis. So again, that sufficient time is devoted to discuss the risk at the board. that appropriate levels of awareness exist throughout the organization in terms of the risk, that the risk management processes work effectively, and that you have a clear risk management policy which is published and promulgated. I'm not going to go through this in any great detail, but you have a number of risks. You have strategic risk, you have people risk in terms of HR and reputational risk. You have marketplace risk in terms of, I suppose, missed opportunities, poor customer satisfaction. Infrastructure, IT is a big one, I'd have to say there. You have ethical risk, you have supplier outsource risk. I mean, your supplier risk in terms of particular elements over the last period of time that are very important to the ongoing maintenance of the operation. Probably IT is a very important one at the moment. Financial, in terms of ensuring that the department is very much aware of what your needs are moving forward, and that your budgets are signed off on in terms of your budgetary package, and that you have a good internal audit in place, making sure that everything is as it should be, legal compliance. I often say on state boards and boards in general, people shouldn't underestimate the importance of reputational risk as a mindset. If you're aware and mindful of reputational risk implications for you, it helps you focus your mind in asking the right questions, because no one wants to be in the court of public opinion looking at a reputational risk instance. And from that perspective, it helps, I find, sometimes that people kind of just every now and then think about the reputation in terms of the decisions that they're making. So as a simple takeaway, as a basic framework, as if you were to look at all that and cascade it down into just a snapshot of how to, I suppose, deliver a mindset, just think about your reputation in terms of the decisions that have been made, and that may help you focus your attention on the matters that need to be focused on. Again, this is what a simple risk register from a state governance, a state codes governance may look like. I'll send it out to you. It covers, as you can see, categories.
Patrick, can I just interrupt you there for a second? Sorry, no, it's Philip. I'm just conscious of time. I know we set a 2-hour limit on this for board members, and I'm just wondering, have we a lot more to go?
Won't be another, I'd say, 10 minutes tops, Philip.
That's perfect, Donald. Or Patrick, thanks very much. Thank you.
Okay. So risk management questions you should ask. Again, they're important, and I'll go through, send them out to you. I suppose the key question is risk a standing board agenda item. And that's the one I would say to you is that do one risk item at each board meeting and just do a dive through it. And that gets you right through it, and that gives you confidence that you're actually getting a good steer of risk right across the organization. Common mistakes which boards make and how to avoid them. Let me just bring that up for you. So again, a common mistake, very common mistake, is the boundaries. What's your responsibility? What's the executive responsibility? Well, as we discussed all through the last 2 hours, your responsibility is strategy making, policy making, appointing the CEO, executive oversight, accountability, and so forth and so on. Their responsibility, the executive responsibility, is operational management, execution, employers of the team, performance KPI reporting and accountability. So excessive board involvement in executive activities blurs accountabilities, and that's, that can lead to governance failures and or legal exposures. So just always separate church and state, if we can use that analogy. So some common board problems: lack of time I've dealt with, avoidance of risk taking. You need to be innovative and you need to be creative in your decision making. Lack of board making, lack of board involvement in strategic thinking. So again, we've covered on that. Lack of knowledge in an increasingly complex world. Keep your gun fighting skills up to date. Keep fresh, keep learning, keep reading, and keep aware of what's going on out there. That's part of your duties on the board, to be aware of the world around you. You're not involved in micromanagement. That's not your brief. Don't go there. Holding on to the old ways is something that often human nature kind of gives us a comfort factor. We've always done it this way. Sure, it'll be all right. It's served the generations that are gone before us well. It'll serve us. Don't go down that path. You need to consider and pursue new opportunities that conflict with some old rules that you may have in place. Just because you always did it one way, by virtue of the fact that we're here today on a virtual platform, shows that we can do it a new way very quickly. So be open to the new ways as well. And failure to see strategic thinking as your primary governance responsibility. That is your meat and veg. That's why you're here. and that's what you're there to actually deliver on. It's at the very heart of the purpose of why you're here. Some final issues. A lack of rejuvenation of board members. Not so much a big issue anymore, I have to say, because of the fixed term and only 2 terms on a state board anyways. So that's dealing with that to a large degree. But generally speaking, that's been an issue. And there is a 9-year rule coming in as well, that you can't serve any more than 9-year rule in terms of best practice on regular boards, and particularly in the charity space. And it's groupthink, and that's an issue that you don't want to kind of fall into. Founder syndrome, not going to go in there. It's not really applying to this, but it's, I suppose, for the founder kind of can't let go, and people very much buy into their kind of ethos and forget the greater good sometimes and get lost in the, I suppose, they lose sight of the forest for the trees. One of the other issues in terms of avoiding board dysfunction is people not taking their responsibilities seriously. I'm sure it's not a case in this one, but lack of mutual respect can be an issue, and you need to have mutual respect for the people that are there. You mightn't necessarily go, be people you go for a pint with or whatever, but that doesn't diminish the fact that they're there of their own right and they're there properly. So you have to give them due respect, and you can work with people without getting on with them. And frequently in boards, personalities can be very dominant. So be respectful of the people that you're dealing with, as you would be. There are no hidden agendas. Transparency is the order of the day. Keep it transparent. One sees, they all see. And don't come to the board with a hidden agenda. It's not healthy, and it always, in the end, it'll come out and it'll do you a damage in terms of how you're perceived by your colleagues. Micromanagement, we dealt with. Off-the-record meetings are never a good idea. I think, a board within a board is often a fear where there's these cabals, or there's 3 or 4 people kind of gerrymandering stuff. Not a good idea. Very, very poor practice. It never ends well. It always seems to end up either in the court or in the, fractious decisions are made, and there's huge fallout. So I think one sees, they all see is generally the best rule of thumb on these things. Don't get bogged down in the rules. Preoccupation with procedures shouldn't stymie the interaction that you have. Disruptive directors, again, can be problematic, but you have to be respectful for each other. And again, the way of dealing with disruptive directors is through the board evaluation mechanism, and you can flag that during that exercise. A lack of external advisors, not generally an issue on state boards, but be mindful that you can have too many external advisors as well, and you have a limited budget, but get the advice that you require when you need it, and get the best that you can and that's available to you. Out of control management, well, you're there to make sure that that doesn't happen, and that's the actual the reason that you exist. And CEOs dominate the board. This is very common, particularly in the corporate space, where a dominant CEO just absolutely rides roughshod over the board and becomes a very dominant personality. You've seen this across the corporate landscape, and indeed the sporting landscape more recently. So that's human nature. You get the it's a common occurrence, and boards are there as a framework to actually protect the shareholder from that very instance. So not going to go through that to any large degree. You can have a look at it. Again, succession planning we've dealt with, and don't need to go through that and anything. And in a large degree, you're in the fortunate position that your succession planning is directed by the minister and through the PASS system. So you have a protection there anyways. It's vested in. I put that up. You can take a look at it separately, but it's just the yin and yang of corporate leadership and corporate governance. You have the qualities that you desire in your CEO are conversely probably separate to the qualities you require in your good board member. So it's just the nature of the beast, and that is the balancing act that chairs and boards have to actually deliver. So it's something to take a look at in terms of, it's just an irony of corporate governance that what you seek in a CEO is the almost opposite of what you seek in a very, very good board member. So finally, excuse me, do your due diligence. Ask to see all important reporting, financial budgets, strategic risk papers. Talk to current and past directors if possible. Are there factions or undue influence by shareholder, director, manager, donors? Is your directorship tied to your professional role? Ask these questions, if joining a board. How many meetings are there? Length, location, frequency, committee meetings, and so on and so forth. So these are questions that be mindful of. Again, I'm just going to go through this. I'll leave this with you in terms of the thing. So in summary, a board needs active, talented, knowledgeable, committed board members. Boards don't need passive or silent directors. Boards need to be future focused and strategically focused. Boards need fresh thinking and new energy. And you need to make sure you know what you're taking on and signing off, as ignorance is not a defense. Play your part in building a sustainable governance platform and ensure your organization goes from strength to strength long after your term on the board is over. Leave it better than you found it, if at all possible. As I said at the outset, any questions, given the time constraints, happy to take them. If you email them in, I'll deal with them. And Philip, if you have any questions, indeed, I'm happy to engage through yourself or through Mary. Thank you. I'm sorry I went a little bit over there on that. And I hope I offered you some value in terms of the presentation this morning. And thank you for your patience. I know it was a long presentation and there was a lot of detail in it, but that is the essential board member. Thank you for your patience and your time and your attention. I appreciate it.
Patrick, can I just say, Patrick, on behalf of the board, we appreciate your time this morning, and I was fascinated with the language you were using: cauterizing, cascading, transparency, transcend. There's always a job for you as a poet if you want to move on to that. And it was a very interesting presentation, not only for new board members, but for existing board members. I think we learned a lot in that whistle-top tour, and we're grateful for your time. I think it's good that we might let you have messages later, because I'm conscious of people's time this morning. It's been a long session, but thank you very much, much obliged.
Great pleasure. I hope everyone stays safe.
Yeah, thank you.
Thank you.
Bye. God bless.